Good afternoon. Can everybody hear me? Good. So from last week, we continue today's session on Islamic banking advances. So if you all have any specific question, please text or please unmute yourself and feel free to ask. I will initially summarize what we discussed for those of you have any questions or who didn't join last time. Then we move on to today's part. So what we started discussing is we defined what is meant by Islamic banking. So we said Islamic banking is the process of financial intermediation where these Islamic banks operate within the principles of Sharia. And we said that this financial intermediation process, that is accepting funds from surplus units or giving funds to deficit unit, can be undertaken. The financial intermediation process can be undertaken without having interest-based transactions. So that's where we started. And the rationale, we said, or the philosophy underlying that thinking comes from, we said, in general, the Sharia principles involved, or the philosophy involved, is that the financing side of any transaction should be linked to external real sector or external sector or fiscal sector, something like that, where there is production, consumption, investment, and that link happens not based on loan transaction. Rather, it happens on alternative transaction, such as partnership, such as sale, such as investment transaction or lease transaction, and not necessarily a loan-based transaction. That's where we said the difference stems from. So we, for the advanced diploma and credit management, we focus on the advanced side, the facilities. So what we said here is, what we discussed at the last session is that we could do these transactions using alternative products, and we looked at partnership, which is referred to as musharaka, as a way of doing financial intermediation. That's what we discussed at the last session. And you can do financial intermediation, that is, you can give money to deficit units, customers, using partnership transaction, right? These are facilities, but on a profit and loss sharing basis. So that's roughly, that is basically what we discussed. We discussed how a partnership transaction can happen at a partnership can happen where we can bank and fund our customers, and what are the differences that conventional loan. What are the differences of partnership compared to a conventional loan? We discussed those details. I'll be very happy to take any questions if you all have. If you practice the question, if you all have anything specific to tell me, please feel free. If you have any clarification, you can ask on the question, because what we also did is we saw in small caselet how this is applied in real life, how this could be the partnership transaction could be used to give facilities to people, right? So essentially, we said this type of transactions, musharaka in this case, kind of directly connects with the real sector, directly connects the bank with the real sector. As such, it can pass on the benefits and the risk in this product and how we need to be sure. In addition to our standard credit consideration, such as about the customer, about the project, about the collateral, about the pricing, about the other types of margin, and so on. What else we need to look at if we sit in credit? If we sit in credit as a credit officer, as a member of a credit committee, what is that? What are the various areas that we need to look at in case a proposal of such nature that comes to us, right? Because in addition to standard credit risk, there are certain product-related risk that is unique to Islamic banking, that may be that is involved in Islamic banking. As such, it is worth us having that extra look at how these are structured, so that we understand the process that we need to follow and where our key risks are. Right? Any questions on that so far? Anyone has any questions? Please feel free to clarify. So how we move forward from now is that, again, like I said at the last session, we have this in the advanced credit diploma because that there are around 16 institutions that have Islamic banking windows or Islamic banking operations. And if you work in any one of them, chances are you may end up having this proposal in your hand, which says the customer wants a musharaka partnership or something like that. And these two lectures won't make you the expert in Islamic banking, but you will have a basic idea of what kind of areas that you need to look at, or how to understand these products for your better understanding of those proposals, right? So in the exams, you are likely to have an optional question in this area, an optional question. So if you choose to do that, you may want to practice the questions that we do here and focus attention on the tunes that we have uploaded. Having said all that, so we will move on to now the slides. So last session, we looked at how a partnership agreement can be made use of as a mode of giving funding to customers. Now, today's discussion, we will start with looking at sale as a mode of financing to customers. So it is well known the sale transactions can be created as a transaction which create financing, right, to customers. So in order to understand that, let me first basically explain the sales structure conceptualized in Islamic banking to start with. So in Islamic banking, we categorize sale into 3 types of sale transaction. Sale transaction into 3 types based on 2 factors, right? So 3 types of sale transaction are categorized, and those are categorized based on 2 factors. First factor is delivery of goods. Second factor is payment of price. So let's take an example of me selling a pen for 100 rupees. Delivery of goods means me giving the pen to somebody, and payment of price means somebody giving me that 100 rupees. That is what delivery of goods and payment of price means. So if both the delivery of good and payment of price happens at the same time, that is a spot transaction. You go to a shop, you give money, you get something in return, goods or service. That is a spot transaction. A deferred transaction, or in other words, credit sale, is you give the goods now, you pay the money, pay the price later, right? So delivery of goods happens now, payment of price happens later on a deferred basis, right? So that is the deferred sale or credit sale. Third type of sale is that you pay the price now, but you get the goods later. It's an example in current context is like a pre-ordered sale. So if a new phone is coming, you pre-order, you pay, but they will deliver goods in future, in 1 month's time, in 1 week's time, or whatever. So where the payment of price happens now, delivery of goods happens later. So these are broadly 3 types of sale that is recognized or used in Islamic banking. And if you follow the trend, there are 2 variables, that is payment of price and delivery of good. Both happens now, or one has to happen now, or the other has to happen later, and the other has to happen later. There could be a situation where both happens later, that is payment of price and delivery of goods both happens later. That is a forward transaction, which is usually the conventional forward transaction, right? That is not recognized in Sharia, in Islamic banking, because when both these parameters are later, in Islamic banking, we assume that it has very high uncertainty. As such, it is generally not acceptable. That's the reason standard forward contracts are not acceptable in Islamic banking. So having said that, there are 3 types of sale. So spot sale, deferred sale, and forward sale. So if you look at this sales transaction, can this sales transaction be used to create financing arrangement? The answer is yes. If a trader sells on credit and gives goods to his customer and says, pay me in 1 month's time, he is in effect giving financing facility to his customer. Although he doesn't give a loan and do financing based on loan, the very fact that he is selling based on credit creates a financing arrangement with customer. So financing arrangement need not be created only based on loan transaction. Even a credit sale transaction could create financing arrangement. That's where we are coming to. So so if goods are sold on spot basis at 100 rupees, invariably their prices on the forward may be slightly low, right? And their prices on the deferred sale may be slightly high. So that is the general trading practice. So the trader makes money by buying something on spot basis and selling the same product on deferred basis, or buying on forward basis, selling on spot basis, or buying on forward basis, selling on deferred basis, where the customer gets more time period to settle the money that is due. At the same time, he gets a time difference where he could settle those over a period of time. So he gets funds, he gets goods, and he gets time to settle for that goods. As such, it can be created, it can be used, it is used as a mode of finance. So same way, this sales transaction is inbuilt into the Islamic banking products to do financing with customers. So instead of giving customers money and telling them to buy goods or services, we arrange this type of sale where customer would get the goods or services and he pays over a period of time to the bank. So there are two products under this category that we will look at. One is Salaam, which is forward transaction. The other is Muraba, which is a deferred transaction, which we will look at in detail. But coming back to the broader point, so instead of giving a loan and creating a financing arrangement, one could use transaction like partnership, transaction like sale to create that transaction. That's how these transactions are structured. So and that's where this alternative type of financing emerges from. So it's in more simple words, let's say somebody works for an organization. His salary is let's say 30,000 rupees, and he gets his salary every 30th of the month, right, or every 25th of the month. So for 30 days, but his salary is paid on a monthly basis. So we can think of that arrangement as financing for that institution for 30 days from that employee. Why is that? Because after every day's work, he has to be paid 1,000 rupees, which the organization doesn't pay. It holds that 1,000 rupees and pays at the end of the month. So he is in effect contributing towards some kind of a financing arrangement to the company, to the organization. So similarly, it is not only a loan transaction that can be used to create financing arrangement, a partnership transaction, a sale transaction, a lease transaction could be used to create financing arrangement, right? So now we are going to look at how we could use the forward sale, which is in principle in Islamic finance, it's called Salaam transaction, SALAM, Salaam transaction. How it is applied, right? So we will use this broad structure to understand the sale-based transaction. So if you want to make money on a forward transaction, you buy forward at a lower price than spot, and when the goods are delivered, you sell on spot basis, so you could make money. So that is the that is a very basic of a forward sale transaction that is used in Islamic banking. Let us go through the slide now. So in the Salaam is essentially a forward sale where we agree with the customer. We give customer funds for a well-defined type of product. We give the funds to the customer and agree with customer that after after an agreed period, customer will deliver us goods, right? So we pay money now, customer has to deliver goods to us after a defined period. So let's say we had to define the goods specifically. This is what we want. So if it is pens, you have to say this type of pen, this number of quantity, if possible, this color of pen, something like that. It is defined. After agreed period, customer comes back, gives us the pens. That is the agreed period. That is the agreed transaction. But in the banking setup, the bank is not necessarily interested in buying the goods specifically. So what bank will do is bank will appoint the customer as an agent to sell those goods on bank's behalf and settle its capital and its profits. So the price is price paid in advance for delivery of goods. Customer agrees, customer gets the funds. Customer manufactures those goods or produces those goods, sells it to the bank, brings it to the bank or confirms to the bank the goods are ready. Then bank appoints him as agent to sell, or bank requests him to sell those goods, and then the proceeds are collected by the bank, both the capital and the required profit that bank is expecting. Is that clear? So the process in Salaam works where the customer approaches the bank and says he needs, so it is in general used for cultivation purposes. Although in Islamic banking, Salaam is in generally used for cultivation purposes. It is not necessary that it is only used for cultivation. Even for millers, it can be given. Even for manufacturing purposes, with a slight difference, all this can be used. But in our case, we will look at the agricultural related facility. That's what we are going to focus on today. So banks in general provides funds prior to the work starts by the farmer or the miller or somebody else. So in a sense, this particular type of transaction is a unique transaction from a Islamic banking perspective, in the sense, in general, you need to pay the cash, you need to have the goods. There is a general rule in Islamic banking that you cannot sell what you don't possess, right? That's the general rule. You cannot sell what you don't possess. That's the general rule. But this particular type of sale is an exception to that rule, because there is a dire necessity to accommodate this segment of people, especially the farmers, especially the people in agricultural sector, who are at the mercy of the markets. Not only now, historically they have been, where market prices going, the volatility in market prices, they are not fully skilled to manage those volatility. As such, they end up on the losing side. That is not specific to a country. It is observed all over the world, where the farming segment especially, they are at the losing side. They are on the losing side when it comes to the markets. Market prices moves, if they move against them, they are in general, their skills and abilities are not adequate, or they don't have enough focus on those to manage the risks related to the prices of their commodities. As such, you will notice they end up on the losing side. They end up being at the lower level of income as a segment of the income earners. Farmers may end up at the lower bottom end of the pyramid, because invariably it is related to the price of their harvest. As such, a sale where you could indicate to the customer the price of their harvest before they start harvesting, price of the harvest before they start harvesting, gives them some kind of certainty, gives them some kind of direction as to where the money is, or how much money they could make, or how much money they are likely to make. As such, that gives the market some guidance by this product. So forward in general is not a standardized, it is a standard product, but it is a kind of an exception product. In order to serve this particular need, because farmers, and historically, they have been at the mercy of the market, because they have to wait for a long time, generally 3 months, 6 months, 9 months for their harvest to come out. Once the harvest comes out, they go to the market. They may or may not get a good revenue. So let's say they get good revenue in one season, it may be followed by bad revenue in 3 seasons. So they are not in general, you don't generally see them as high income earning segment. As such, offering some kind of market certainty, price certainty to them is recommended to ensure overall economic upliftment of all societies, all segments of societies. And that's the real rationale of this product. So if we could, that doesn't apply to only farmers, even for manufacturers, this is to some extent true. But farmers, especially because their harvest is generally perishable, as such, it makes much more sense to offer them. So the process is, again, if you look at the conventional So if you look at the conventional facility, the bank gives funds to the customer engages in farming, takes return and pays to the customer, pays to the bank, repays the capital and the returns and the interest to the bank. But in Islamic banking, the bank gives facility to the customer so that he harvests, he goes to the market, and he delivers the goods to the bank. So to some extent, bank has to look at the price risk related to the product very carefully to ensure bank's capital and returns are safe, so that bank does not take unacceptable prices. Right. So that is the essence of the product. Where in conventional banking, the transaction between the conventional bank and the farmer is based on loan transaction, whereas the farmer produces, goes to the markets, recovers his cost and return, and then repays them, right? But essentially, those two sides are not necessarily connected. So it is not directly connected. There is, of course, a connection if the market prices doesn't come up to the expectation of farmers. Of course, the repayment to the bank may become questioned, but contractually, at least, this obligation is irrespective of the price in the market for the harvest. Whereas in Islamic banking, if you look at the slide, the process, customer pays to the bank, but he recovers from the market. As such, the price, to some extent, the price is taken by the bank, right? So customer has to deliver the goods to the bank. Delivering goods doesn't mean on the due date customer comes bringing all the goods to the bank. In general, bank will appoint him as agent to sell or request him to sell the goods, get the proceeds, and those proceeds is what bank will recover. So there could be, so in practice, how does it happen? In practice, once we agree, so there are two broad risks that the bank has to look at. First is nature of goods, what kind of goods that we want to, what kind of segment you want to fund in this, because where the prices go, prices are very volatile. Prices go up and down very frequently. The risks related to that are very high, right? So the variation in prices, if they are very high, bank needs to be extra careful in funding a customer using a Salaam transaction. Where prices are relatively stable, right? You can fund on a Salaam basis with additional comfort, because whatever the changes, if they are stable or if they are minimal, that can be incorporated into the pricing, right? right? We will look at the caselet in trying to understand this little more. Delivery. So goods, moving on to the next slide, the goods have to be clearly defined. So what is that we are buying? We have to define it as clearly as possible. If it is paddy we are buying, you have to say what kind of paddy, what time period he has to deliver, how many kilos, some kind of a basis of defining it. If you are buying phones on a forward transaction, you have to say what make, what capacity, or what model. So the goods had to be described as clearly as possible, because if goods are not described clearly, it is not acceptable in Sharia. So it can lead to uncertainty, which is a concept we discussed under the principles, as such may not become acceptable in general. The second point is price for the goods that is being bought in forward has to be paid in full. Meaning, if the price of the goods is 100 rupees, the 100 rupees has to be paid at the start of the contract to allow the for the Salaam to be an acceptable sale from an Islamic perspective. So that is a condition that there could be some difficulty in fulfilling that. The reason is that, especially in agriculture, we don't. The common practice is that we don't fund all 100% of the facility at the start, right? We may hold back part of the funds. We may give initially, we may give funds stage by stage. So initially for clearing the land, for seeds, for pesticides or things like that, we will give initially. Then for the pesticides, the labor and things like that we pay. Then when we finish, we at the third stage you may give for harvesting, for clearing, for milling and things like that. So in general, you will disperse the funds in stages, especially for agriculture purposes. And giving all the funds at the outset may prove difficult, especially in Sri Lankan context. So what are our options? This is one area in practice sometimes difficult to think, because this is a requirement that you need to pay the price of the goods in full, right? Let me explain that again on the board. So if you are buying 1,000 kilograms of paddy at 10 rupees, you have to pay at the start, 10,000 rupees. You have to pay the price in full. That's what it says, right? That is the requirement. But generally, let's say we disperse the funds in 3 stages. What you could do is, instead of buying the 1,000 kilos, the requirement is the amount of goods you are buying, you need to pay the full price. So you don't have to buy all 1,000 kilograms. You can buy 300 kilograms at the start, stage 1. Stage 2, you can buy the balance 400 kilograms. And stage 3, you can buy another 300 kilograms. So 30%, 40%, and 30% in this case, something like this. So although there is a requirement to pay the price in full, there is no requirement to buy the entire harvest for ourselves. So how much of the harvest we buy in practice, what the banks do, is to decide not to buy the full harvest, buy part by part, so that the funding can be given on a staggered basis, without paying the full amount at the outset, because that may it may be more prudential to stagger it from a credit perspective, because when you pay the full amount, although it's a requirement under Salaam, if you do that, it may be sometimes difficult to manage the utilization of the cash, which can lead to indiscipline. Customer may spend the whole amount on not on the harvesting, on something else. As such, it is not recommended. And so in general, when we implement, if we want to give facility of, in this case, 10,000 rupees, the 10,000 rupees is staggered and paid to the customer depending on the requirement. So first, to buy his stocks, clear his land, we pay 3,000 rupees. Then for him to buy seeds and do the plowing and related activities, we give another amount. Then once the harvest comes, to harvest it, to clean it, to mill it, and things like that, we give funds, so that it is staggered and it is used for the purpose that we intend it to be used. Going back to the slide again. So it is not permitted. So in Salaam, we use Salaam as fresh funds to buy goods. So already, if the customer owes something, to the bank, it is not treated as the capital in the new Salaam. So normally you need to give cash. If he owes you money on something else, that can't be converted into Salaam capital. That is a Sharia requirement, because the product is designed to allow farmers to get some cash prior to starting their harvest. Salaam is also used in certain banks, like a pre-packing credit, where in export segments also, although more used version is called istisna. It's also a type of forward sale. So going back to the general perspective, credit perspectives of Salaam on the slide. Is there any questions? Good. So in terms of purpose, mainly Salaam is used to fund agricultural sector. That is, that gives some kind of a price guidance, some kind of a stabilization of price, because forward price helps to stabilize the price to some extent. amount of funding is limited by the value of underlying value of the stock in the underlying transaction. So you cannot, despite the nature of collateral you have, despite the customer's value, the funding that could be given on Salaam is limited to the underlying transaction. This is an essential feature in many of the transactions you will see, many of the Islamic banking product you will see this. The nature of the value of the funding that you could give is always related to the underlying transaction, underlying asset. So even here, even in Salaam, how much can you funds? In our previous case, if in the example I just wrote, if we are buying 1,000 rupees worth of 1,000 kilos worth of paddy at 10 rupees each, it is worth 10,000 rupees. You cannot give 20,000 rupees on Salaam transaction. For some other transaction, you can give the customer facility, but under Salaam, you cannot give 20,000 rupees. You can maximum you can give only that 10,000 rupees, but that is also not maximum. We look at it in the caselet how we decide the maximum amount to give. We have a small question coming up. In terms of tenor, Salaam facilities are normally used for short-term purposes. You don't give a long-term Salaam because nature of transaction is short-term. There is a price risk, so banks prefer in practice to manage the price risk for the short term, because very long-term price risk management will be a little more complicated, will involve a lot of assessment from the bank side. Short term is what is preferred. So the pricing in terms of the returns to the bank, the return is the difference. Like I said in the description of sale transaction, the return is the difference between the spot price and the forward price. So if the forward price is 90 rupees and the spot price is 100 rupees, the pricing or the return for the bank is the 10 rupees margin. That's the return. And that return should compensate for the risk the bank is taking. So bank will generally have a yield curve or the expected price based on different tenors. And so on. So if the curve is like this of the expected return, yeah. So this may be like the risk-free rate. To add some premium for that, for credit. Then based on the collateral, you will add some more and you will arrive at the pricing. That pricing will be 12%, 13% or whatever the percentage. That is what you will get in the pricing sheet. But what the treasury will give business or what the head office will give the branches will be that pricing sheet that will say for 3 months facility, 3 months facility of a A-grade customer with this type of security, will be at this percentage, something like that. So if this is given, we need to work out how to offer a Salaam, how to offer a forward sale. That gives us a return, expected return of this particular percentage. The pricing sheet will remain similar to what is used in the conventional bank, maybe based on the treasury bill, previously SLIBO or something to start with, adds a premium for credit-related risk of the customer, adds some more premium perhaps for the security type of security offered, and arrives at that yield curve. But the requirement for the credit is to ensure, requirement for the business is to ensure we get that rate using the Salaam structure. We will look at it as we move forward. So that is the point on pricing. So it is the difference between the spot price of the commodities involved and the forward price paid to the customer at the start of the Salaam deal. Documentation, both standard documentation, the offer letter, the whatever the security documents used can be taken. In addition, Salaam document specifying how the Salaam will happen will also be included in the documentation. Collateral, if mortgage is available, mortgage can be taken. The goods involved, once they are prepared, once they are ready, once they are harvested, once they are ready, can also be pledged to the bank. So pledge documentation can be used. The bank could along with the customer, could control the goods prior to sale. That is also possible. And the maximum amount of value recovered, again, this is what we saw in the Musharaka also, that is the partnership also. How much money can you recover from the customer? The maximum amount that can be recovered from the customer is the value of the goods. Value of the goods, Salaam stocks. We cannot recover anything more than that from the customer, other than in case we go for legal action, the administrative cost of legal action. Other than that, we cannot recover anything more from the customer. As such, the total amount we can fund is limited by the value of the stock, and the total amount we can recover using the collateral is also limited by the value of the Salaam stock. Repayment in general, the Salaam is structured as short term, and often a bullet payment is what generally is possible, but there could be other variations also. In case customer delays, there is some room to reschedule where we could charge more if there is sufficient buffer, but beyond that, charging more will be difficult because of if there is no sufficient buffer. We will discuss that point when we address the question, right? When we do the case line. Any questions so far? Any questions? No? Okay, let's move on. So in terms of some of the key risks that we need to have in mind when we engage in Salaam will include we include, because Salaam is a product, I just alluded to this previously, Salaam is a forward sale product. The general requirement is that we disperse the whole amount of the whole price consideration, but we need to align the disbursement to the requirement, to the sales and collection process, and ensure the proper utilization and proper collection is monitored and ensured, so that the credit risk is minimal, right? Credit risk is minimal. Here there is one more point. The agreement, Salaam agreement, is that we give funds to the customer and customer delivers us the goods. There is no specific requirement the customer produces the goods, right? The Salaam agreement is a forward sale agreement where we give money today. So it's more like, you can think of it as pre-booking a phone, pre-booking a laptop, pre-booking something like that, right? You pay the money to a company, you expect it will deliver to you, right? It doesn't necessarily mean that company produces it. If the company doesn't produce, it has to buy from somewhere else and give you. So, but in the agriculture sector, chances of the farmer buying from the market and giving you is very limited, right? So essentially, farmer has to manufacture the goods to deliver to the bank, right? Or deliver the proceeds to the bank of its sales. As such, that needs to be taken into consideration when Salaam transactions come to the table, right? Because there may be a legal obligation or written obligation for customer to deliver the goods to the bank, irrespective of whether he produces or not. But in terms of behavior, the bank will not get cash flows unless customer produces and sell them. Chances are very minimal, unless in a situation like a miller or situations like where customer does not produce. Then of course he can buy from the market and deliver the proceed sales price. But if it is a farmer who produces the harvest, if he doesn't produce, irrespective of the contractual agreement, chances are if he doesn't produce, you won't get repaid. So that's the credit risk, and it needs to be monitored, and the disbursement need to be aligned to that to ensure that risk is minimal, right? So this risk is in addition to the standard risks related to agricultural funding. Price risk, this I alluded to earlier also. If the price of a commodity is very volatile, if the averages are moving up and down over a period of time, if we are unable to establish a decent average yield, here what I mean is yield per hectare or yield per, not the return yield. What I mean is number of kilograms of harvest or hectares per hectare or acre or whatever. If that is not established clearly, the return that we could get also gets diluted, right? So that needs to be both the price and the harvest needs to be estimated when we look at Salaam for farming purposes, for agriculture purposes. So in terms of operational risk, once the harvest is made, once the customer confirms availability of goods, there is operational risk of ensuring those goods are under proper control till it is sold. And we should also have some estimation of time to sell and recover cash, whether it will take 1 month to recover or 3 months to recover, depending on the commodity. So those are the broad factors we need to have in mind, in addition to standard risks, to understand Salaam specifically. So if a Salaam proposal comes, how long does the customer requires? Because customer is required under the Salaam agreement to make available the goods to us. He is not, he is incentivized by us to sell them in the market, but all he is required is to give the goods to us. So ensuring we sell those goods at the right time and recover is what we need to monitor post harvest. That also remains as a key operational risk. Any questions so far you all have? No questions? Good. So we have a question here. If you all can take a screenshot, I will put the full screen. You all can take a screenshot and attempt it. I will give you a little time. If you can try to do the question, then we will do the answers together. Can you all see the question? So I will give you 10 minutes. If you can attempt the question, then I will do it on the board. So let's look at the question now. Question says, Mr. Mahesh, a paddy farmer who owns 12 hectares of paddy land in Mana, rice bowl area close to Giant Tank, is planning for cultivation next season. He expects a yield of 5,300 kilograms of paddy per hectare as net harvest during the season. So he owns 12 hectares of paddy land, and he expects a yield of 5,300 kilograms per hectare. As net harvest during the season. So as net harvest during the season, he expects 5,300 kilograms. He approached an Islamic bank on 1st of September. He approached the bank on 1st of September Yeah. 1st of September. Approach an Islamic bank on 1st of September for a facility which he confirms that he will settle in full bullet payment by 31st January next year. 31st January next year. For 5 months. So the indication is the facility is for 5 months. Sorry, the by next year after the sale of paddy at an average price of 35 rupees per kilogram. So he will harvest roughly this into this amount, so 0.06363. So he expects a total amount of harvest of 63,600. How did I get that? He owns 12 hectares of land, paddy land. On average, the net harvest from each hectare for the season is 5,300 kilograms, to a total of 63,600 kilograms. And he expects the price to, after sale of paddy, at an average price of 35 rupees per kilogram. This paddy can be sold at 35 rupees per kg. The bank is prepared to grant him a Salaam facility. So within brackets, it says Salaam is a type of sale, right? So sometimes it's very easy. The question itself specifies the nature of the product. So you will at least remember what it is, right? So here it says Salaam is a type of sale for 5 months and requires a return of 12% per annum. So bank is willing to pay, give a 5-month facility, and the required return is 12% per annum. So that's the details given. The first question is, what do you understand by? So the first question is, what do you understand by Salaam facility? So now here you need to define what is Salaam, and how it is a facility given by Islamic banks, or it is a facility given in Islamic banking for customers who bring in produce on a forward sale basis. So generally it is used for agriculture purposes, and the definitions like that with the process could be included under the question. So it is very important to define it very clearly. There have been certain instances people misunderstand this. People who didn't come for class, when they read what is Salaam, SALAM, they think it is Salaam or something, and write funny answers. So this is related to forward sale, not the Assalamu alaikum that Muslims tell between them as a form of greeting. This is about a forward sale which is used as a financing product, right? So we will first calculate the first question is to define what is Salaam. So it needs to be defined. The TUT has the definition. It is a type of forward sale, and the process is included. We just discussed. Second, calculate the maximum facility amount. Calculate the maximum facility amount that could be offered to Mr. Mahesh, assuming the yield and the market price given by him are reliable, and he could sell the harvest and collect the cash by 31st January. You may assume the bank disperses the full amount on 1st of September. So what the question says is bank disperses the full amount on 1st of September, right? 1st of September bank. So what is the full amount? So we need to calculate what is the maximum facility. So the information he gave is that he has 12 hectares of land. Each hectare expects to get a 5,300 kilogram net harvest. That's one of his assumptions. Number two, he says each kilogram can be sold at 35 rupees per kilogram. Now the question tells to us both these are correct. Both these are reliable. Based on the history with the customer, we know when he says he'll be able to sell at 35 rupees, chances are he ends up selling 35 rupees. When he says 5,300 kilograms per acre, chances are based on the history, he will end up getting 5,300 kilograms, right? If both of them are correct, right, we don't doubt, we don't create any question mark on those. What is the maximum amount you will be able to, what is the maximum amount, maximum facility that could be offered to Mahesh if you are expecting a return of 12% per annum on this facility? You are expecting a 12% per annum on the facility. What is the maximum amount you will give? So in order to arrive at it, first we need to arrive the sales proceeds. Sales proceeds is the multiply 63,000 into 600, 63,600 into 35. Let me do that quickly. Please use a calculator. If I make a mistake on the numbers, please feel free to tell me. $2,226,000. $500. $2,226,000. That's the total sales proceeds. Right. So the total amount that we can recover from Mahesh, both our capital and our profits put together, is 2,226,000. So that is what we need to understand to start with. So if that's the case, we are funding this 100%. So there is no specific amount that is going to be contributed by the customer. First question is, if we are to fund, and provided customer puts zero amount into this particular transaction, how much maximum facility will you give? If our expected rate is 12%. So if our expected rate, and that is for the 5 months, right? If our expected rate is 12 months, 12% for 1 year, for 5 months, our expected rate is 5%, right? How did I get it? If for 12 months, your expected rate is 12%, right? For 5 months, you will need 5%. So this particular sum includes the capital plus our profit, which means this is 100% plus this 5%. So in effect, 2,226,000. So maximum amount you could give the customer will be $2,120,000. What does that mean? Provided that he contributes zero from his side to this transaction, we have to only recover our capital and our profit, and we expect 12% per annum for 5 months, right? That is 5% on this facility. The maximum we can give him, provided that he is clear for this amount, and the information he gave is reliable, meaning there is no uncertainty, there is no volatility on this price of 35. It doesn't go up or down by 5% or 10%. The yield from a hectare doesn't go up or down by 5% or 10%. We will give him a total facility for the 63,000 rupees, 2.12 million rupees, that is 2,120,000 rupees. And after 5 months, he will sell that whole proceeds at 2,226,000 rupees maximum, and will give us the difference between these two as our profit. He contributes zero he contributes 0% capital into the transaction, and he doesn't get any return on this. He may be getting on the overall return. We are only funding this portion, and we get the returns of 12%. But here the discussion goes to how much, whether these two are reliable, and the question requests us to assume these two amounts are reliable. That is the price and the yield. Is that clear? Any questions on that? So if we disperse this amount, we will exactly get our capital and profit, nothing more, nothing less, right? Provided that he gets the full yield and he sells at the exact price. Agree. Question number 3, question part C. What is the maximum amount a conservative banker would offer as Salaam facility if the maximum variation in yield is 5% and the variation in price is 10%, if the full disbursement is to be on the 1st of September. So first part, question 1, question 2 answer is 2,120,000, provided that Mahesh puts 0 amount into the transaction and bank funds the whole amount. Bank will get a return of around 5% for the period or 12% per annum based on the information given in the question. Now the third question is, what is the maximum amount that could be offered if the maximum variation in yield, again, sorry, we have to go back to the question again. He has 12 hectares, 5,300 per hectare. So that is 63,600 kilograms and 35 rupees a kilogram is the price. Now the question incorporates, question says he is reliable, but we observe changes to the actual number. Although he says 63,000, we need to keep some buffer as a mode of precaution, as a management, in order to manage the risks related to that. And that is the normal practice. The first part of the question is to explain without that risk how it will look like. But in general, there is some risk that the expected yield or the expected price is not achieved by the customer. So we need to incorporate that amount of change, that amount of variation in our calculation to identify the full potential. Right? So it becomes little more closer to reality if we bring in that change. Calculate the maximum amount of facility to be offered by Mahesh. Sorry, what is the maximum amount that could be offered as a Salaam facility if the maximum variation in yield is 5%? So yield could change plus or minus 5%. Price could change plus or minus 10%. Now here the question says yield and price could change. So we are going to assume, and the question gives us a little lead there, saying if you are very conservative, meaning you are not looking at possible high, the positive increases, you are only looking at negatives, right? Because that is your maximum hit, right? So we will take only the situations where the yield and the prices are below what the customer is saying. So that limits our risks. So 5% below this will be 6,360. So 5% below is 60,420. kilograms. 10% minus is 31 rupees and 50 cents. 350 is the difference. 350, 34, 35. So these two together is the new expected sales proceeds, which will be $1,903,230. Let me double check that. 6420 into 3150. 1,903,230. Which divided by 1.05. 1,812,600. This is the amount of facility that we will offer to the customer. If we assume, although he says 63,000 kilograms of paddy at 35 rupees a kilogram, since there could be variation, the prices could be up or down by 5% based on our judgment, based on the history of the product, based on history of the price movement. The prices could move 10% plus or minus. We take both the negative outputs, that is, we assume although he says 63,600, he will be only able to produce 60,420 kilograms. Although he says 35 rupees a kilogram is the expected sales price, he will end up only receiving 31 rupees and 50 cents. We arrive at the expected forecast sales price. That sales price is discounted based on our expected return. So this is the price paid now to receive the goods expected in 5 months' time, right? So price paid today is 1,812,600 to receive 5,000 to receive the harvest in 5 months' time. All clear? Any questions? Any questions? So we are basically calculating. So the right answer to the question is to calculate based on this nature of product, which limits the amount of facility that could be given to the customer. What is the total amount you will be giving to the customer, right? So that's what the question is. The question is not about his the type of mortgage he gives us, or the credit limit internally set, or anything like that. That is standard credit consideration which will apply for sure. But on top of it, is there a product related limitation on giving him any facility? The answer is this, right? There may be other factors. There may be various limits that we need to look at before setting him a facility. Amount of credit limit approved, amount of current utilization, type of facilities, type of mortgages, or type of collateral he has given. All that matters. But here what we are looking at is the specific limitation due to the product being used in Islamic banking. What kind of limitation does he have? What kind of limitation does he have in order to, what kind of limitation does the product give to give him facility? Let's say we give him, in this case, we give him anything more than this, anything more than 1.8 million, right? Despite him having much bigger security. Let's say the security he has given us is worth 5 million rupees. If we end up selling the if we appoint him to sell and he ends up getting us a net proceeds of 1.9 million, if we give anything more than this, we will get lower return than 5% we want, right? 5% for the period, or 12% for the 12 months. You'll get less than that, because if this goes up, we can't increase this, right? Because if he only gets so many kilograms at this price, that's the amount against which we can recover, right? We can't recover from his other cash flows, because the contract, the underlying contract of sale, is to get the returns from the sale identified. It's not any sale we can recover from. It is precisely described, this is what we are giving funding against, and we will recover from this transaction. So that is the limiting factor in Islamic banking, because it is linked to a particular transaction. This particular type of funding, we cannot, he may be, this is paddy, he may be having some other harvest from which he is receiving money. We cannot recover from that. We have to only recover our returns from the transaction we funded, right? Any questions? Any questions? Is that clear? The question, we move on to the part D of the question. Describe the key steps offered. Describe the key steps in offering Salaam. We go to the next part of the question. It says, describe the key steps. Sorry, describe the key steps in offering Salaam to Mr. Mahesh if he requires funding to be dispersed in the following dates. If he requires, okay. The question says if he requires, but in general, if the bank requires, it doesn't want to pay the entire funds together, the 1.8 million in this case, or whatever the amount. So it says the customer requires proportion of the funding required 1st of September. 1st of September, 30%. 1st of October, 20%. 1st of November, 50%. So 30%, 20%, 50%. Describe the key steps. So the steps is very simple. Of the funding to be offered, or the amount of harvest, you purchase, if you are purchasing 63,000 kilograms, 30% of that, 63,600 kilograms, 30% of that we purchase on 1st of September at 35 rupees. Or if you are purchasing 6,420 kilograms at 31.50, we purchase 30% of that, right? 30% of 6,420 at 31.50 during the 1st of September. If we are purchasing 6,300, we purchase the balance 20% by 1st of October and the balance 50% by 1st of November. So depending on the case 3 or 4, that is question part C or D, sorry, part B or C, we will decide. You can write either of the cases. The answer is the number of kilograms we purchase will be based on this percentage. Yeah, is that clear? Depending on the number of kilograms we are purchasing, the kilograms will depend on the proportion that we would like to disperse or customer would like to take. Because if you give him 100%, in general, in agricultural sector, you will not be giving the 100% on day one, because it may create financial indiscipline. It may create issues in managing that credit. You will generally disperse, because you could ensure you could gradually disperse based on clear set goals, so that recovery becomes much easier. Utilization is for the specific purpose is ensured, and that is done by purchasing goods whilst ensuring the principles of Sharia are met. But is the principle involved here that we need to pay in full to purchase, but we don't have to purchase the entire amount. We can choose to purchase based on whatever that we are comfortable with, based on the amount we are comfortable. So the answer to that, the steps is to purchase 30% of the harvest, expected harvest. You can say in example, in situation B, in question B, it will be 30% of 63,600, or in question C, it will be 30% of 60,420 to start with on 1st of September. Then you purchase a balance 20%. Then you purchase a balance 50%. You don't disperse the whole amount in full, right? It says the purposes here, preparation of nursery, cleaning bunds, canals. Yes, the purpose is, of course, that's the reason why it is being used, so that the purpose, the 30%, we can monitor whether the nursery has been prepared, the bunds are cleaned, and canals and bunds are cleaned. Leveling and plastering bunds and seeding, all that has happened, can be monitored, so that utilization of funds is ensured. Then for 20% of disbursement for weed controlling, fertilization, fertilizer application, pest and disease controlling, water management. So these purpose, once it is defined, can be monitored so that disbursement happens by stages, right? That can be done even in Salaam. In the same way, in an agriculture conventional facility for agriculture, we do that. It can be done in Salaam also, right? Part E, describe the steps adopted by the bank in case of delays of pre-settlement in Salaam facility. So how do we handle delays or pre-settlement? So it depends on the buffer, right? So delays and pre-settlement, I'll start with delays. Now, if we expect the price to be 31.50, we have kept in a 10% buffer on the expected sales price by the customer, right? Meaning, in actual sales, we give the maximum disbursement amount based on this price. Any price higher than this is a buffer for the bank. And in practice, what happens is if bank disperses this amount, and if the customer gets anything beyond this amount, meaning what? If instead of 31.50, the customer gets 31.75 or 32, bank recovers its amount, the expected profit, and the balance, which is 50 cents per kilogram for 60,420 kilograms, which is roughly around 30,210 rupees, is given back to the customer as the incentive, right? Bank does not take this money in general practice, because bank sets out its expected return at the start, right? We are looking for 12% return. Bank takes that return and gives any excess that we recover in the process to the customer as incentive. That is his incentive to sell the goods, because customer's requirement is he delivers the goods to us. On top of it, we tell him, okay, now we request those goods to be sold at the highest price possible, give us our capital and profit back. In case he ends up selling at higher price, in this case, instead of 31.50, he sells at 32. The 50 cents per kilogram, or 30,210 rupees, is given back to the customer as his incentive. So he doesn't have to worry about selling at a higher price at all, because bank is not interested in taking that price, right? Bank will say, you sell anything beyond this price, 31.50, all that comes out of that sale is yours, right? Our expectation is 31 rupees and 50 cents. If you can sell at any price beyond that, please feel free. What will happen is we will not recover it. We will recover from your account only this price, so many kilos at this price, which is 1,903,230. Right? You don't have to even bank that into our account. Whatever that arrangement that he has with customer, he can say, so we will only recover this amount. So any amount that is beyond that is an incentive for the customer. Now, in case of a delay, we will monitor the cash flows, and let's say by 1 day or 2 days or 3 days, depending on the buffer we have from the actual sales price, we could recover what he owes us. So instead of 5 months, the customer delays it for 6 months, and let's say we have to get we had to get 1 more %, right? So let's assume that. Let's take, we need to get 1 more %, and that works out to be how much, whatever that percentage is. As long as this 50 cents covers that %, we are okay to, for instance, let's say we have to take 15,000 rupees more for 1 additional month. This is not a calculation, I'm just saying. We will add that and we will take 1,918,230. If due to 1 month delay, if you work out the numbers, it says 15,000 is your additional amount. We cover from that buffer. But if we had to cover 45,000 rupees, we will not be able to cover from the sales proceeds, because sales proceeds, the additional amount is only 50 cents. So depending on the amount of actual price, only we can recover. So total amount that we can recover is the total amount that we can get as sales proceeds. Beyond that, we cannot recover. So there is a limiting factor. There is a limiting factor on the total amount we can recover from the customer. That is limited, like we said in the slides. That is limited by the amount we can sell these sales proceeds, and that's what we can recover from the customer. In case he pre-settles, meaning he harvests early and he settles, a bank will keep some margin on top of the agreed margin in order to manage pre-settlement risk and give the balance back to the customer. Because banks generally on Salaam will only recover what it is due to what is due to it based on the expected margin in general. So if there is a premium for pre-settlement risk, which is common to the bank will use that pre-settlement risk premium and recover a little more from the accepted rate here, and the balance is given back to the customer. So describe the steps to be adopted by the bank in case of delays and pre-settlement in a Salaam facility. Delays, bank, if there is sufficient buffer, so that's where the buffer comes in, the 5% plus or minus. So in our case, we keep the minus, because if it is more, there is buffer for us in case of delays. Discuss from a credit perspective how a Salaam is similar to and be different from a cultivation loan given by conventional bank. Now we have discussed the differences. So it is similar to a cultivation loan in that both Salaam and a cultivation loan can be given for cultivation purposes or agriculture purposes. So in that sense, the purpose, the type of purpose can be similar. Both conventional and Salaam facility can be given for agricultural purposes, right? Both can accept standard types of collaterals, right? In many other cases, the harvest, post-harvest, you can accept the harvest as a pledge. That is one way you can offer, and where available, where the customer is willing, where it is possible. If there is a mortgage can be accepted, but that may be a limited number of cases. So those similarities are there. Where there are differences, nature of contract, Salaam is a forward sale. Conventional loan is a loan contract. Return is the profit. Price difference between spot price difference between spot and forward price. Interest. Losses. Possible if spot price goes below forward price. No concept of loss. Again here collateral. Both you can accept all types of collateral. You can give clean also. But here amount recovered will be limited to, it's also in the tube, the value of the Salaam stock. Here based on the value of the collateral. So interest, so there is no penal rate involved here. There is no, unless specific administration costs, nothing else is involved. Only the difference between spot and, let me read this. Nature of contract is a forward sale contract. This is a loan contract. Returns is profit. The price of spot, the price difference between spot and forward, where spot price is higher than forward price, you will get profit. Here you agree on an interest rate, so fixed or floating, you get the interest. Losses possible. Now in this case, in Salaam, losses are possible. How is it possible? In the previous example, we said we buy the goods at 31 rupees and 50 cents. Right? So today we bought 60 something. Let's assume it's 60,000. 60,000. Yeah, let's assume it's 60,000. I can't remember the amount. 60,000. We bought at 31.50. Right? Customer brings 60,000 kilograms of paddy after 3 months or after 5 months in this case, but the market price dropped from 31.50 to 30 rupees and 50 cents. Right? Customer is not required to make good that loss. Right? If the market price dropped to 30 rupees and 50 cents, each kilograms of paddy we will earn 1 rupee loss. So we are still exposed to the price risk of the market, right? So loss is possible if the price drops. It is up to the bank to review the product, review the price, and ensure in majority of cases that the price we are offering does not fall below the market price. But in case for whatever reason it drops, bank will incur the loss. So in general, very basic statistics. So if you look at the price, so you can see, if you take the price variation, right? Maybe around 99% chances that it won't drop beyond a certain variation, right? I mean, definitely there is some chance of things happening beyond that, as is the case in financial markets. But chances are majority of the time, especially small, equally distributed tickets, right? The chances of you making huge losses will be mitigated if the number of deal tickets are reasonably diversified. Chances of that loss can be minimized, but the possibility still exists. If the price goes below the agreed price, the bank has a possibility of earning losses. In conventional loan, you have to pay contractually. You have to pay the loan and the interest. As such, there is no concept of losses, at least on the contractual side. Collateral, we discussed that, limited to. So those are the differences in terms of purpose. And the collateral purpose is for agriculture purposes. Mainly, you can, if it is a cultivation loan, and the Salaam also can be used for cultivation purposes or agriculture purposes. Any collateral you can take, whatever that is used in the industry. So there is no restrictions on that. You can get kind of expected return, but return is if you take both profits and losses together, those remain as differences in the Salaam compared to conventional loan. Any questions on that? So this is a type of question that this is the nature of question you will receive at the exam, something similar. And this is the expected way to handle it, Please do the question so that you will be more familiar with the question, because 3 months down the line, when you go for exam, you may not remember the terms. So that practicing them immediately makes sense. You don't have to worry too much about the Arabic terms. You write in plain English. You explain what it is. Salaam is a forward sale. You write like that. That is more than enough. Of course, you need to understand the differences and specific credit-related aspects that will play a role when it comes to giving these facilities on Salaam basis, and what kind of risks we are facing need to be understood in answering these questions, right? So with that, we will take a break for 10 minutes, and we will come back and continue the session, right? Okay, let's continue. The institute requests me to remind you of assignment being uploaded. Please check that, complete, and submit to the institute based on the deadlines. we go back again to our slides. So what we just discussed is about a type of sale. Salaam is a forward sale, which can be used to give facilities to customers, especially in agriculture sector. Although we don't give a loan, charge an interest, and say repay it for this purpose, we have an alternative way in Islamic banking to give that facilities. However, that alternative way carries with it different types of risks and rewards. As such, understanding how it works is what we try to do here now in the small case that we did. We try to understand how it works, where the risks are, where possibly we could go wrong if you don't pay focus to the areas. From a credit perspective, the amount that we could give on a Salaam facility is limited based on the underlying value of stock. Amount of return we could get from the Salaam facility is limited by the value of the stock. As such, we need to carefully evaluate both the yield and the price in a given structure, so that bank recovers its capital and its returns in the expected manner, right? So that its yields for a given set of facilities, for instance, agriculture facilities, could be maintained only if these two go hand in hand. It is better in a Salaam facility to underestimate or keep some buffer in the expected yield and price, and where the customer comes up with higher yield and price, to return back those as incentive, rather than giving the full amount of price and the yield expected, because such discount or such underestimation helps us to adjust in case of delays, which could happen naturally in facilities such as agriculture. Gives us that amount of buffer to manage any risks related to delays, any adverse price movements in the market. It gives us some buffer. So although we know on average, let's say in our case, if the price is to be 35 rupees in the previous case, giving the maximum price of around 31.50 or something like that, which can be mutually agreed with the customer, gives the bank, in case of delays, in case of low yields, bank's risks are mitigated to some extent. Having said that, a customer will be looking for more funds because he needs funds to do his harvesting, cultivation, so that it's a balance again between the customer requirement and the amount, the risk appetite that bank will take on this. Having said that, the underestimation doesn't mean customer loses out. It's just that he will get the total proceeds when the sales happens rather than at the outset. Because banks generally don't take the full amount, they take what is expected and give the balance as incentive to the customer. It helps in two ways. One is managing bank's risk. The other is customer will focus on selling the goods at the maximum price, so that bank's interest and customers' interest are aligned by giving a lower amount. Yeah. Any questions you all have? Okay. So we move on to the next question, next area, that is facilities for individuals. Facilities for individuals. Where in general, so we go to the tute slide. I'm assuming you can see this. For individuals, also facilities can be given in the same way. We can give facilities for businesses, which both cases what we looked at is possibly giving facilities to businesses. Similarly, we can give facilities to individuals also, based on agreed standard contracts of Islamic finance. For instance, you can give housing, leasing, some kind of personal financing for purchase of purchase of durable goods. Again, the amount that you can give is restricted by underlying transaction. However creditworthy customer is, we cannot give just funds. It is always based on the underlying transaction. The funds, normally the tenor is offered short, medium, long term. Pricing can be market-based price. You can charge other fee income related to the advances in general, but you can't charge things like penal interest or late payment fee and things like that. Documentation, standard type of documentation, including offer letter, security documentation, all that applies. In addition, there is also product documentation related to Sharia, identifying what exactly the customer is getting into. Collateral, if it is housing, you can take mortgage. If it is leasing, you can normally take the hypothecation. The vehicle can be in bank's name. Any other collateral is acceptable. Personal guarantees, liens, all that is acceptable. Repayment, generally on installment or bullet basis. General installment basis for retail consumer facilities is acceptable. Some products do not offer the flexibility to reschedule, so you can't say after agreeing to pay in 10 months, now I want to pay in 12 months. Sometimes some products don't offer that facility, but there are certain alternatives for that. So that's the general understanding of individual facilities. So the first product here is lease. What I'm going to do is skip lease. I will go to the next product. I'll come back to lease after we finish this. The reason is I'm going to deferred sale. That is 3, that is Roman numeral 3.b, deferred sale Muraba. So lease, I will come back to that because Murabaha is easier to explain soon after we discuss the sale product. I will go back, explain that, and come back to this. So we said the Salaam facility is a forward sale, right? Salaam facility. So we are looking at deferred sale now. Deferred sale, which is called Murabaha. So deferred sale is where we sell on credit. So if we buy on spot and sell on credit, that is known as Muraba. We buy on spot and sell on credit, where we disclose our cost and markup, that is known as Muraba. So that's because of that, Murabaha is also referred to as cost plus markup sale. Cost plus markup sale, where the seller discloses his cost and the markup. So it is like I go to the shop and I ask, I want to buy this pen. Would you like to sell me on Murabaha? Meaning what? The shop owner will say, this is the cost I bought. Because of Murabaha, I will add this markup and sell it to you, right? So that where the cost and the markup are disclosed, which facilitates people to evaluate whether they want to buy or sell or participate in that market. That's the idea. But sometimes it may look strange if I go to a shop and ask, how much did you buy this pen at, rather than the price of this. The shop owner may be surprised. He will say, if you like my price, take it, otherwise leave it. But that the original practice of Murabaha is to understand margin. See, the modern day, the margin can be understood by looking at the financials of the entity. If I go to a supermarket, let's say Cargill's, I buy this, I may not know the markup on this particular product. But if I take the financials of Cargill's, I may be able to calculate on average how much margin they keep on products. Not specifically to one product, but in general, what is their margin, I should be able to calculate. Looking at the gross profit, looking at the sale, looking at the cost of sale, I should be able to calculate. So similarly, the Murabaha sale is to disclose the gross margin and make sale. It is generally applied using deferred sale. So meaning it also comes with a credit period to repay the capital and profit. So I'll draw the diagram on the board. So in this case, an Islamic bank buys from the supplier a pen at 100 rupees, sells it to the customer. So the supplier is from whom the bank's customer buys the goods from. So Islamic bank buys from the customer, buys from the supplier, sells it to the customer with a markup, bought at 100 rupees, kept a markup of 20 rupees. So it sells the goods at 120 rupees with a 3-month tenor. With a 3-month tenor, meaning he can pay back this in 3 months' time, right? And we are assuming it's equal installment, so 40 rupees a month, 3 months, the customer pays back Islamic bank, and Islamic bank makes a profit in this transaction of 20 rupees, right? Whereas conventional bank gives the loan to the customer and says, pay me back 20 rupees, 20 rupees interest, or 20% interest in this case, for the period. Customer purchases the material from supplier and he continues his business. So that's how the processes differ. So essentially, it's buying on spot and selling on deferred, which is what we saw as a framework for sale just before we started Salaam. The framework we agreed for sale. There are 3 types of sale: spot sale, deferred sale, and forward sale. The spot and deferred sale combination is the Muraba combination. Spot and forward sale combination is the Salaam combination. So we are going to the next type of transaction. Now, the sale can be incorporated into allowing facilities, especially for retail customers, where they purchase durable goods and things like that, even services. The same process can be used where bank gets involved in their purchases and offers them time period to repay the cost of their purchases without giving them loan and charging interest. So sale process, again here in this case, linking with the actual sales process, actual transaction between supply and customer. The bank connects and keeps a markup for that period, for that out of fund situation, and it earns a return, a markup. So both the banks, conventional bank and Islamic bank, are out of funds 100 rupees, and after 3 months they get 20 rupees. So it looks like, so in a sense, out of funds for 3 months, you get a return of 20 rupees, same return. But underlying products are 2 different products. In Muraba, which is here. So the full name is by Al Muraba, but we normally use Muraba, the second part. We disclose cost and markup. We offer them on deferred basis. And it is not necessarily bank directly buys from the supplier. For a lot of reasons, practical reasons, we appoint the customer, we request the customer to purchase, and we fund the account. That can be done also, right? So, however, there are differences between just giving a loan and charging interest, as against buying and selling on markup, right? Buying and selling goods on markup. Because loan transaction, where interest is calculated as a function of time, will be different from a sale transaction where the return is calculated as the percentage on the cost, right? Two different things. So return is calculated based on the cost for an agreed period. Here on the loan side, the loan return is calculated based on loan and the tenor. Although even on markup, a tenor is inbuilt, tenor is calculated. When the tenor changes, the markup won't change because tenor is not a key function, right? We will look at it as we go on to do the questions, right? Going back to the slides now. So Murabaha process involves a bank buying specified goods from a customer, and in general it is bank pays cash, right? So in general bank pays cash. So bank purchase immediately on spot basis and sells to the customer on deferred basis with the markup, and customer settles the bank over a period of time. That's the general process of Muraba. In order to be compliant with Islamic banking law, Islamic banking principles, there are a few things that we need to pay attention to. One is the customer and the supplier can't be related parties. The customer and supplier, the customer here and the supplier over there, cannot be related parties. They have to be independent suppliers, right? Independent people. Because if you buy from the same person and sell it to the same person, right? If they are not independent parties, and if you buy from the same person on cash and sell it to the same person on deferred basis, the restriction related to buy-in, that is restriction related to buyback, which we discussed under the Islamic banking principles, will apply. So it is not acceptable to buy and sell from the same party. As such, both the supplier and independent party, supplier and the customer has to be two appointed independent parties. Customer could be appointed as agent to bank to purchase from the supplier. So in general, bank will not get an invoice in bank's name. You can still, the invoice can be in the customer's name and the purchase can be made, right? There are certain banks, especially in other jurisdictions, which use something called a promise, because after the first step is concluded, so this is bank purchase. This is the purchase, step number 1. This is the sales step. So buy on spot, sell on deferred, right? Buy on spot, sell on deferred. Those are the two main steps. Keep a markup, of course, and generally give a tenor and recover that money. Yeah. So when there is no connection between step number 1 and step number 2. At the time of purchase, bank cannot say the customer has to buy from the bank. Those two cannot be interlinked because of the general principles in Sharia. You cannot link those two. So meaning, but let's say bank purchases pens at 100 rupees from supplier, then bank goes to the customer, and if for whatever reason customer says, no, I don't want these goods, there could be a risk. So in order to avoid that risk, in some jurisdictions, banks require what is called a promise to purchase from the customers. And if the customer, after bank purchases the goods from the supplier, fails to purchase from the goods from the bank, still bank cannot force him to purchase. But if bank sells those goods and incurs a loss, bank has the right to recover that loss from the customer. So purchase to promise is used in that sense. Breach of promise is used in that sense in certain jurisdiction, but it's not a common practice in Sri Lanka. In certain jurisdiction, it is used to recover in case the customer, especially when the goods have volatile price, you do a transaction, you agree a transaction on Friday evening, by Monday morning prices have changed. Things like that have happened in the past as such. Banks generally take some kind of commitment from the customer to buy those goods. If he fails and if they incur losses in selling them, that is recovered from the customer. There is also a concept of rollover. There is no concept of rollover in Muraba. So what it means is, once the second stage is completed, that is the purchase and sale, both are completed, the relationship between the customer and the bank is that of relationship between the customer and bank is that of debtor-creditor relationship. In our case, if the bank purchases 100 rupees and sells the goods at 120 rupees, the relationship, the amount due is 120 rupees. The bank gives 3 months time, whether he settles in 2 months or 5 months. The customer owes the bank only 120 rupees. That's the important point. Whether he settles in 3 months or in 5 months, customer pays the same amount, 120 rupees in our case. So if you draw the returns or the cost of Muraba, right? Let's say I denote as R Muraba, and this is the due date. Right? So this is whatever percentage, let's say 10%, right? So for the first 3 months per annum, let's say this is 3 months per annum, return is 10%. The day after, so the return is 10% per annum. And after the 3 months, after the 90th day, we cannot charge anything more till, let's say, he brings on the 5th month and gives. The return here is 0. We cannot charge anything more, right? And if we delay in a conventional facility, we can charge a penal rate, we can charge a late fee, or that may be RMU plus other charges, right? So the black line the total cost of Murabaha does not change with delay, whereas the total cost of the loan, if it was at 10%, same rate as RMU, could increase fairly steeply if on due date it is not paid due to the additional rate. Not only the agreed rate, the additional rate will be inclusive of other charges. As such, the Murabaha transaction per se, so first is, this is on the return, there are 2 points here. One is on the returns on Murabaha. We cannot, delays cannot be priced in general. That's the first point. Delays cannot be priced in general. If there is a 10 days delay, you can't charge anything more. You find for 90 days, he comes back on 100th day or 120th day, we cannot charge anything more. But so the reason why it is so is that when we are giving Murabaha to customers, we are to look at their cash flows. We are to look at their working capital cycle and give Murabaha based on that. Number of days it will take to produce a goods, number of days it will take to sell goods, number of days he will need to repay, rather than just give, because if we take that into consideration, we will create, because by nature these products bet on the financial discipline of the customer. They try to inculcate financial discipline in the customer so that if there is a delay, it becomes a problem for the bank. Of course, it can be argued if we don't charge, chances are customer could misuse it, right? And there have been cases like that. But in large majority of time, if the customer is trusted to pay on time and we don't charge anything, behaviorally he can be coached, he can be brought in to pay on time, so that we estimate the time he will take to repay more carefully and give facilities based on that. Failing which, where a customer tries to purposely misuse the system where, so if it is an occasional delay, Islamic banks in practice let it go. If it happens, let's say a couple of times rather, they relook at and discuss with the customer whether the 3 months agreed is adequate for him, whether we need a pricing margin for 4 months or 5 months, because that seems to be his cycle where he could settle. So those and so in general, banks wouldn't, on an occasional delay, banks wouldn't charge anything. Banks will bet on his financial discipline in the future cycles. Where banks see a couple of times or more, banks will extend that time so that banks also keeps earning. At the same time, adjust that time period he will need to, when it's a regular facility, when he needs to resettle the facility. Where somebody purposely, systematically delays installment after installment, there is special approval, special Sharia approval to charge a penalty much higher than what even a conventional bank would charge, so that behavior is discouraged. So if somebody systematically try to misuse a penalty, there is provision to allow charge a penalty. But the general condition of Sharia is that such penalty is to discipline the customer not to earn money for the bank as such. It should not be used as an income for the bank. It should be given away as charity. That is the general rule. Now, because we purchase goods, keep a markup, and sell it, Murabaha, let's say if the customer comes and says, I need a Murabaha for 3 months, I calculate my cost, which is 100 rupees. If my markup is 12%, I calculate for 3%. I tell him the expected sale price is 103 rupees to be settled in 3 months. When he comes to the 90th day, if customer comes and says, can I roll over this Murabaha for 1 more month, like a conventional facility where the customer is willing to pay for the 1 month, but he would like to extend the facility. That is not possible in a Murabaha unless customer does another Murabaha, because Murabaha cannot be, you cannot once the markup is agreed, it cannot be changed because there is a delay in payment. That is not acceptable in Sharia. So invariably, there is no rollover in Murabaha. It should be settled in full, and a fresh Murabaha can be done if customer requests. So Murabaha is used both in business facilities and and as facilities for individuals. Some of the key parameters we'll discuss quickly. So predominantly it's used to buy durable goods or for buying inventory or finished goods when it comes to businesses. Working capital requirements. The amount of financing is limited by the value of underlying transaction. That is common, we have seen in all the facilities. So if I want to do purchase a fridge, if I wanted to purchase a laptop, if I want to purchase a bedroom set, we purchase, keep a markup, sell it to the customer, who will settle over a period of time, right? So because the price is fixed, because the price is fixed, generally there is generally it is short-term facilities. So it can be extended. It can be extended as a long-term facility known as extended Murabaha. But the rate cannot be changed. So there cannot be a pricing. So under pricing we have said it's fixed. Fixed means the markup we can charge on Murabaha of a single transaction is fixed. All right. So it's like fixed term borrowing. It's not a flexible pricing. It's not benchmark. It cannot be, although at the time of pricing it can be benchmarked, price cannot be revised on a periodic basis. Price is fixed. Documentation, standard documentation should be taken, like the offer letter, like any security documentation. In addition, Murabaha documentation should be taken where we say we purchase this, this is the markup, we sell this to you. We need to specially note there is special provision in Banking Act, Schedule 2 and Schedule 4 for LCB and LSPs, which allows banks to purchase, keep a markup and sell on goods on this. Collateral, any collateral can be taken. It can be given clean also. There is no issue with that. In general, if it's retail facilities, banks will look at durable goods. Bank will look at some assignment of salaries for employed, for people who get regular income, some kind of guarantee if that is required. Those are the general practices. Repayment can be generally installment basis. It can even be bullet basis. You cannot roll over Muraba. You cannot reschedule saying 1 more month I need, because bank cannot charge anything more. If it needs to be done, it has to be a fresh Murabaha or some other alternative facility needs to be arranged. So that's the general comparison that we can look at compared to, let's say, loan for the purposes of buying some durable goods. Now, loan for a purpose of buying durable goods need not be fixed pricing. It can be flexible pricing. It can be long term also, because there is no because of the flexible pricing. It can be long term also. It can be rescheduled. So those could become the standard variations. But having said that, Murabaha is a type of product where after the sale is complete, that is after bank buys the goods and sells it to the customer, and the goods are delivered, there is no risk to the bank in terms of the product price risk. The price risk is mitigated after the sale. As such, generally, the chances of bank losing money on Murabaha is almost zero. Almost zero, meaning after the sale, bank does not lose money on Muraba. So because of that feature, because all the other products so far we have covered, there is a chance of bank losing money. That is, bank losing its capital. Here in this case, Murabaha bank does not lose its capital, because once the sale is over, there is no concept of loss sharing. As such, it is practiced very widely, especially by the Islamic banking industry, because no price risk, no risk related to capital after the initial transaction is over. The credit risk is after the sale by the bank. The relationship is debtor-creditor relationship. So it is the credibility of the debtor that determines the repayment. Because sale is an absolute contract, we don't look at how profitable the sale is for the customer. And in retail cases anyway, it doesn't matter. Pricing is fixed. So pricing markup is fixed. So it is not generally suitable in volatile risk environment, volatile interest rate environment, or volatile rate environment. So that's the reason why, especially in a volatile environment, banks tend to use this for short-term purposes. There could be, however, operational risk related after the bank purchases the goods before it is sold to the customer. If there are any risks, those risks need to be covered by the in the operational handling. So when the customer is appointed as an agent to buy, those risks are covered, for instance, related to insurance or handling and things like that. So so the durable goods to purchase durable goods, if banks offer facility for retailers, that can be done using Muraba. in certain cases, vehicles are also leased using concept of Murabaha. Although majority it is used ijara, which we will cover again. So there are instances where Murabaha is used as the facility to cover the durable goods, because leases tend to be long term, tend to be 5 years or something similar, 3 years. Banks sometimes prefer banks use ijara in general, but Muraba is also used. Some other finance companies tend to use Murabas in local setup too. So those are the key features of Murabahas. We purchase goods. So it is the other side of Salaam, where we looked at Salaam as a forward sale. This is a deferred sale. Bank purchases at current cost, keeps a markup and sells it to the customer, right? Any questions you all have on that? Anything you didn't understand before we move on to a small caselet? Everything understood? Okay, let's do this caselet fast. We have around 40 minutes or so, 40-50 minutes we need to cover. So if you can do this fast, we will discuss soon. Take a screenshot, attempt it. I will work it out. We'll take 10 minutes. Okay, so let's do the questions. Read through the question. Mr. Rehan is employed as a senior executive in a private sector company. He seeks to purchase the following items prior to his wedding from ABC suppliers. Right? Bedroom set 125,000, wedding suit 35,000, LED TV HD 75,000. He has 50,000 and approaches Islamic Bank for the balance amount. He asserts he could settle the facility in 6 months. What is the Murabaha facility? So the first question is what is meant by, so generally for the exam purposes, the first question will be will be a general question, but you understand by Islamic banking, the difference between Islamic banking and conventional banking, or some principle, but you understand by prohibition of interest in Islamic banking. Is Islamic banking does not charge interest, so is it cost-free? Something like a general question will be there. That is your first question. So you should be able to write in general, at least, since we are only covering for this course only the advances. So for any question, for instance, what is a Murabaha? Murabaha is facility extended by an Islamic bank, will be a right answer because we are only covering the facilities. Just writing that much is a right answer to start with. Of course, you should write it is based on sale, it is based on credit sale, where bank purchases on spot, sells on credit with a tenor, with a markup and a tenor. That's even better. Then if you can draw a diagram to show how the process works, that's a complete answer, right? We have covered that in the tute and in the board, so I'm not. That will be the answer to that question. Explain the steps involved in offering Muraba facility to Mr. Rehan if the expected return on similar facility is 12% per annum. So now the question is, how do you offer Rehan a Muraba facility? So remember we are doing this for individual facilities. So we will put down bedroom set. $125,000. Suit is 35,000. And TV 75,000. He's buying all these three together. So 235,000 is the total amount he needs for his requirements to purchase durables or purchase his items involved. Now he has 50,000 rupees. All right. In general, so there is small complication in this question. So we need to identify what we are purchasing. That is a requirement in Islamic bank. You can't just say we will buy this, we will sell this. You have to say what we are purchasing, what we are selling. So if it is tea that is we are buying, that is called divisible goods. Divisible. If it is tea, you can say for this amount, so many kilograms of tea we are purchasing, because you can divide them. So based on the amount of requirement, you can identify exactly what and what we purchase, right? Because it can be divided. But here in this case, he's looking for a facility of 185,000. And you can't identify a single item for that 185,000, right? You can't say half the bedroom set or half a suit or half a TV or something like that. Not practical to say. So in that case, how do we structure the Murabaha is the question. So the easy 150, this is 160,000. So if we had 65,000 here, or 75,000 here, we can use these two. If you wanted 160,000 facility, we could use these two to create a Muraba, right? Here, since there is no such thing, he needs more. He needs 185. We need to use two items, maybe these two, for 200,000. But only take into consideration like an initial settlement of 15,000, so that we take the markup only for 185,000 rupees, right? So let me show that. So if it is supplier, bank, customer, that's the process, right? So if you buy something for 100, we give 100 plus 20 rupees markup. 120, if it is just one pen, 120, and say pay back in 3 months time, or pay in 3 installment of 40. That's what we discussed initially. Now this changes when it comes to an odd number and the goods are not divisible. Goods cannot be identified to cater to exact requirement of the customer. What we do is that we purchase bedroom set and TV for 125 and 75 for 200,000. We sell them to him at, the markup in this question is 12% per annum. 12% per annum. So this is 6 months facilities. So 12% per annum. %, per annum, 6 months facilities, so 6%, which will work out to 11,100. 11,100 is the expected return. So we purchase 200,000 rupee worth of a bedroom set and a TV, B&T. Keep a markup of 11,100 and sell it to him at 211,100. And by taking the 15,000 from him, because we have taken additional amount of 15,000, we settle it on day 1. So amount due from him will be 196,100. So that is as if you add this, that will be 196,100, capital and the profit, right? But you cannot do that in a sale process, because it's not just getting the 196,100. It has to be purchase something goods and sell it to the customer. And you cannot say I buy for 196,000 because there is no item here. You can buy for 196,000. This is 125, unless you buy part of the TV, which is not practical. It's not divisible to that amount you can buy. If you are buying sugar, you can say 11.3 kilograms. But when you are buying items like this, durables, this is how you purchase the whole amount. You add the specific markup only for the amount customer requires, and treat his amount as settlement on day 1, day 0. So the total amount is booked. So of this 50,000, 15,000 will come into the account. The entire amount can come in, go to the customer, or at least the 15,000 comes into the account and be settled, right? So the question is, what do you understand by Murabaha? Explain the steps involved in offering Murabaha facility Rehan if the expected return is 12 steps. So step number 1, purchase a bedroom set and TV for 200,000 from ABC suppliers on cash price by the bank. Keep a markup of 11,000, which is calculated like this. That is 185 into 6% for 6 months, I think. Yes, 6 months. And calculate the markup. Markup to be added is this. You add this markup, and then say on day 0, part of the cash is treated as settlement, so that we only give him facility 185,000. And the balance is our profit, which he has to pay over a period of time if he agrees. So if this is bullet payment, this will be the total amount. If it is paid over 6 months equal installment, you cut this, divide this by 6. So it's roughly around 32,667 or something like that. This divided by 6 monthly installment. If it's bullet payment, that will be the amount paid. So the steps has to describe the purchase and sale and the markup involved. So that is question number B. Explain the steps involved in offering Muraba to Mr. Rehan if expected return on similar facility is 12%. C, in case the supplier agrees to offer 1 month credit to Mr. Rehan, how will the above structure change? Now, there is a small, the question includes a little more difference to the standard process. The ABC supplier says, I don't need the funds now. For this price, if you're buying all this, you can settle me in 1 month's time. So the supplier himself is giving 1 month credit. Now Rehan needs 6 months credit. Of that 1 month, for the same price, supplier is giving credit. So meaning bank does not have to go money out on day 1, 185,000. Bank will only need to go money out after 1 month. So the markup is not for 6 months, markup is for 5 months. Right? That is the difference. So the markup, the process will remain same. The markup and the payment will change. How will the markup change? 185,000 at 5%. How they arrive at 5%? 12% for 5 months. Right? So that is 18,500, 9,250 rupees will be the new markup. So 250, 194,250. So again the purchase will be 194,250. So here purchase both these. $9,250 and so 209,250. 209,250 minus 15,000 will be 194,000. $194,250 will be the total amount due And if it is 6 months installment divided by 6, 3, 2, 7, 32,750 will be the monthly installment if it is settled on equal installments. So if the supplier provides 1 month credit to the customer and we are purchasing from the customer, step 1 will be purchasing the selected items, which is 200,000 worth. 200,000 worth, again, like in the previous question, bedroom set and the TV for 175, 125, 75,000 respectively. So total amount 200,000. Then we calculate the markup to be kept because funding is required only for 5 months. For 185,000 only, we calculate the markup to be 9,250. That is the 5% of 185,000 because it's 5 months, right? And that markup is added to the amount 200,000, 209,000, 15,000 is deducted because the customer has 50,000, and we have, instead of buying only 185,000, we have ended up buying 200,000. So that is deducted here. So the total amount is 194,250. So what has changed from the previous question is that the supplier is offering 1 more month of facility, 1 more month of credit free of charge to the customer at the same price, and customer is taking that. So he doesn't have to pay that. So bank pays to the supplier after 1 month from the date of transaction, or bank gives money for the customer to pay to the bank after 1 month from the day of transaction, because that's the agreement. Bank does not also go out of funds from the first day of transaction. So that's how the Muraba process will change and the relevant markups will change. Mr. Rehan is unwilling to, so the D part of the question, Mr. Rehan is unwilling to offer any property for mortgage. Given Islamic banking is asset-based, will this be an issue? Discuss. So mortgaging is not the asset-backed process that we discussed in Islamic banking. So even clean, this facility can even be given clean, irrespective of any mortgage. One is for the small amounts, especially in retail funding, unless it's housing or things like that. Small amounts, transactional costs related to mortgage may be very high, so that it doesn't make sense to take mortgage, right? But mortgage is not a requirement of Islamic banking. Mortgage is taken as a collateral. It's not, it doesn't mean that every Islamic banking facility has to have a mortgage. Asset-backed means underlying transaction, there should be assets like the bedroom set and TV set, TV and the suit and things like that. But assets or goods or services in the transaction. It doesn't mean every transaction has to have a house as a mortgage or property as a mortgage to do Islamic banking. That's not the case. All right. So this understanding that given Islamic banking is asset-backed, will this be an issue? Answer is no. Islamic banking is asset-backed, meaning the underlying transaction, there is a real asset in underlying transaction. But it doesn't mean is that you need a mortgage. The customer may not be willing to give a mortgage, partly because it may not be The transaction cost involved in mortgage may be high, partly because he doesn't like, but if it is employed as a senior executive in a private sector company, as the question says, we may have to look at other ways of securing the credit in case of a default. For instance, we can get salary assignment. For instance, we can get some kind of guarantor. So those can be used rather than mortgage, and using them does not infringe on the transaction being Islamic. That is purely a credit decision which we could decide. Right? That's the answer to that question. So given the Islamic banking unwilling to give property for mortgage, any property for mortgage, given Islamic banking is asset backed, will this be an issue? Answer is no. Right? That's the answer. And discussion is why he may be unwilling is this reason, perhaps due to the cost of mortgage, because it's a small facility in terms of absolute number, or even if it is a large facility, if he is not willing to give, the bank could consider assignment of his salary or guarantor as suitable, as appropriate in its risk appetite, but it will not change the compatibility with Islamic banking principles, because he is unable to give the mortgage. Okay. Question E: if the customer settles Murabaha, capital and markup only end of 7th month, could bank charge any additional income? Explain. Bank cannot in general charge any additional income. That is because it's a sale, even on the 7th month or even after 6 months and 15 days, not 180th day, 195th day or 210th day he comes and settles, we will only be able to charge from him, in this case, 194,250. We can't charge anything more because it's a sale transaction. So there is nothing more. But banks generally have a provision to charge penalty in their Murabaha agreements, so that in case bank is convinced the customer is trying to misuse the system, bank will charge an additional fee, and bank will charge a penalty. But the Sharia guideline is that such cannot be for the purpose of benefiting for the bank. It should be given as a charity. So bank cannot make use of that for its profitable purposes. It has to be given away as charity. If the customer settles Murabaha, how is Murabaha different from a conventional bank loan? So conventional bank loan and Murabaha, you can write based on our discussion so far, you can write the differences. Nature of contract, Murabaha is sale or deferred sale. Deferred sale contract. Conventional is loan contract. Returns to the bank is markup, fixed, or flexible rate interest. interest charged fixed or flexible rate, delays in general cannot charge for delays. In general cannot charge for delays, can charge for delays. Penal rate can be charged. If charged has to be given as charity. If charged has to be given as charity. Thanks. If charged has to be given as charity. So delays, in general, you can't charge anything. If charged, in order to discipline the customer, in order to mitigate the systematic risk, it has to be given as charity. Here, penal rate can be charged. Rollover or extension, not possible on the same contract. Conventional loan can be rolled over. So rescheduling, which is already covered in the slide. So something like this need to be written in point form or in table form to explain the differences. That will be complete. Any questions you all have on this? Any questions? So we'll quickly run through Ijara, that is leasing, which we skipped to start with. So may need 5-10 minutes, but we will try to focus on this quickly and finish. So the other facility in Islamic banking we will cover for under individuals is leasing, which is called in Islamic finance Ijara. Right? Leasing, which is called Ijara. So in many ways, it is similar. Leasing is acceptable in Sharia because even conventionally, leasing is based on an asset. The bank gives an asset and charges a return for the use of asset. In Sharia, in Islamic banking, the concept is somebody owns an asset, right? Owns an asset which is non-consumable. Without selling the right, without selling the asset, offers the use of right. Or within brackets, benefits of the asset. He doesn't sell the asset. He doesn't lose the control. He offers the use of right or benefits of that asset for a fixed period, for an agreed period, for an agreed price, for an agreed rental. For that, we pay a rental. So lease, in that sense, or Ijara, we own an asset which is not consumable asset, right? Own an asset like a motor vehicle, like a machinery, a fixed asset, right? which without selling the asset itself, we offer the usufruct of the asset, that is the benefits related to owning that asset, such as usage of that asset, for an agreed period, right, whatever that period may be, in return for the rental. So instead of purchase price, we get rental, but instead of selling it, we offer on lease. That's what the lease is in Islamic banking, or the original. The ijara leasing is what is meant by this is what ijara leasing is. So even in conventional banking, lease is based on giving an asset, the usufruct of it. If you look at the lease agreement, you will see clauses related to usufruct. But where Islamic banking perhaps differs from conventional banking in this aspect, because the underlying the concept of leasing is very much close to Islamic banking, because it's not just giving a loan and charging interest. It is you're providing some asset and getting a return related to that asset, the usage of that asset. But the conventional leasing agreements perhaps has multiple clauses related to interest, or clauses added to in such a way, or it's structured in such a way. Although the underlying contract is leasing, it ends up looking like it's a loan contract with interest. As such, those interest clauses make it not so Sharia compliant. Otherwise, the overall concept is very much close to Islamic banking concept of ijara. So if conventional banking has a product which is closest to Islamic banking, ijara will probably the product, except for the interest clauses and how it is calculated, perhaps. So this is what ijara is. The definition of ijara is the owner of the asset without selling, asset which is not consumable without selling, offers the usufruct related to the assets for an agreed period for an agreed amount of rent. So at the end of the tenor, at the we will come by the Islamic banking related rules. The rental amount can be fixed or floating rental. It can be like 50,000 rupees, or we can say we will benchmark it to AWPLR plus 3% or whatever. It can be fixed or floating in the same way conventional lease fixed or float. If lease can be fixed or floating. If the bank is the owner, certain types of maintenance, and this is generally interpreted as any maintenance that has to be done by the manufacturer remains with the bank. So there could be certain types of maintenance costs, especially in terms of machinery and things like that. Sale and leaseback arrangement is possible. It can be done even on ijara. So if you own an asset, that asset can be the basis on which you obtain a lease. So you sell the asset to the bank first and lease it back over a period of time. That can be arranged. So lease is the general concept used in different legal contracts, whether for operational lease, whether for financing lease, or for hire purchase. Lease, the lease ijara as a underlying contract can be used under different legal requirements. right? Again, amount of financing is restricted to the value of assets, subject to any prudential regulatory requirements. If there is a 50% limit on vehicle leasing, for instance, or type of vehicles, that applies. But in general, you could give value of the asset. Long term, because it's 5 years or so, in general, if used in motor vehicles, price could be fixed or floating. Standard documentation and product documentation related to ijara are signed. The vehicle asset itself is the collateral. So in vehicles, bank is registered as absolute owner. Repayment equals repayment equals the capital and profits. That is like the conventional lease. We will come to that in the caselet quickly. Possible, you can reschedule. If you have taken the lease for 5 years, you want 1 more year, you can continue to pay lease, and you can repay. Although if the capital and rental are paid, capital and the interest portion equivalent are paid, bank may be willing to transfer it at the face value, as a gift. So it is because the return, if the usufruct disappears from the asset, bank cannot charge. Bank is charging for the usufruct, and let's say bank gave facility to take a machinery. Machinery is not functioning because of manufacturer's default. So there is no usufruct. Then we cannot charge for that usufruct, right? Price leasing can be fixed rental, where you cannot charge fixed rental. It can be also where it can be charged fixed rental, but fixed rental won't change with the benchmark, where the interest rate environment is volatile. It's good to go for the benchmark rate to mitigate any price risk. Maintenance of lease assets need to be looked at, especially machinery related maintenance need to be looked at, because any area where usufruct of the asset cannot be established, we will be unable to charge rental. So there is a question, small caselet. I will skip that. You don't have to worry about it. Muraba we covered. There is something called diminishing musharaka, which is the concept we use to give facilities for the customers on for housing. You don't have to know much about it, other than that fact that it is a type of musharaka, type of partnership, which is used to give housing facilities. So in a musharaka question, if there is a question asking what is diminishing musharaka, diminishing musharaka is a partnership. It's a type of partnership where the capital owned by the bank reduces over time. The word reduces is diminishing. Musharaka is partnership. So bank, let's say a customer wants to buy a 10 perch property. Bank buys 9 perch. Customer buys 1 perch. Every month, let's assume customer can buy 1 perch back. So over 9 months, customer will buy 1 perch from the bank and pay a rental for the balance portion. That is diminishing musharaka. So it's a housing related facility, as long as you know it's a housing facility, and where the capital contribution of bank reduces over time. that should be good to write, right? So you should be able to define what is the definition, diminishing musharaka. We didn't do a question on ijara, so chances that you will get a question on ijara, nothing. But you should be able to explain what how a leasing is. So we have covered during last session and this lesson what Islamic banking is, how it differs from conventional banking, what are some of the key products used, and how they are used in practice, right? So for question purposes, we will be using the area covered in the last two. If there is a question, it'll be a optional question, and we will be covering these areas mostly on the questions we have already done. There may be a theory question. There may be a question where you have to write a bit on what is Islamic banking, how do you understand a musharaka is, or the differences between a musharaka and a conventional loan, something like that. So that will be your question. If there is a question, it will be an optional question. You may or may not do it, depending on your other questions you all choose. So with that, we can conclude. If you have any questions, I'll be more than happy to answer. Otherwise, we can conclude. The links will be available with IBSL. Anybody who wants to relook at it can look at them and understand. Any questions you all have? Okay, with that, we can stop. Thank you very much.